Hi there, everybody. It is time to get started, and we appreciate you being here right on time today. It's very nice to have you in our room. This is Craig at Max Trading, and we are just excited about today's presentation. Actually, you are among the first traders to learn about the new upgraded edition of our Max training courses. And I can assure you this is a wonderful time to add max methods to your charts to give your trading results just a big boost. It was more than 4 years ago now that Eusebio began to see the need for a reliable indicator that would help us deal with the changing characteristic of the markets. And he began developing and working and testing the Max Enhanced Trade Format Indicator. That's a mouthful, so we just call it the ETF. It has been available to upper-level members of the Max community for a few years now and has proven itself again and again as a very effective addition to Max trading. And so now we have added the ETF to every level of Max training. Every course that we teach now includes the ETF. So this means you can select any level of Max training, and you will also get the ETF indicator and instruction in how to use it. So for you, this can make a huge difference. It will give you a real shot at becoming a successful trader. So all of that makes this a truly exciting time to get in on Max trading and to take that first crucial step into productive trading. You may really need a source of extra cash every week for yourself and your family, or maybe you're just wanting to be in a position to help out a friend or a relative. And I'm sure for some of you there is some worthy cause that has your attention, and you can sort of imagine yourself being in a position to make a real difference. Max is the place to begin turning those dreams into reality, and I believe you'll be very glad that you attended today. In fact, just a few minutes ago, before we started the session, Eusebio and I were talking about what a strong and productive system Max has become over the years. And really, once you have the full system under your belt, it's a little bit hard to experience a losing week. That's a lot to say, but that's true. And more good news, tuition rates are not going up. We are keeping our tuition exactly the same even for these upgraded courses, and we'll show you a little later. By the way, we do believe that it's important that you get to see Max trading methods in real-time price action on live charts so that you can see for yourself the effectiveness of the system. And I'll be sending you an invitation to attend a real-time trading session so that you can do just that, see it for yourself. As the developer of ETF, Eusebio is the perfect choice to take us into the world of Max trading. Eusebio is a truly phenomenal trader, and fortunately for all of us, he is also a skilled teacher, and he enjoys teaching, and I believe you will quickly come to appreciate his passion for helping traders become successful. So Eusebio, we appreciate all that you do, and I'll give the microphone to you.
Thanks, Craig. Thank you very much for that introduction. And welcome to everyone. I'm really glad to see a lot of people attending this presentation. And before starting, let's make a quick video and audio check. Do you see my screen and do you hear me well? If you would like to type a yes or a Y in the question area, I would really appreciate just to know. Okay. Fast answers. Thank you very much. I like that. And I see some Max graduates, so it's always nice to see some of our former students. So, well, before starting, let allow me to give you a very quick background who I am. You have most probably guessed to my accent that English is not my mother tongue. I am indeed a Belgian. I live in France and in Belgium, and now I have relocated definitively in France because I love France. I am a full-time Forex trader since 2008. And in 2009, mid-2009, when Dr. Jim Pruitt passed away, his two collaborators, Craig and Chris, who had the mission to continue teaching the Max, has asked me to become a Max instructor, which I have accepted, of course, and it was a great honor for me, but also a great pleasure. And so I am a former software engineer. I have a professional career of around 30 years in that profession, with the privilege to have spent the 15 last years of my career in the banking industry, in important bank in Europe, in France, in Switzerland, in Germany, in Belgium, in UK, in several countries. So, and this has given to me the opportunity to be in contact with several traders in banks and to see how they approach trading in the market, and sometimes how they can move the market. And of course, there is no one strict method used by the traders in bank. There are a lot of approaches. Each trader is almost an exception, in fact. But I have a longer experience in trading and investing. Indeed, my experience is around 34 years now in almost all the markets we can trade: the stock market, the options market, the futures market, and since 2000, the Forex market. One market I have never really deepened is the bond market, because I find trading bond very boring, but it's an important market. And just for one point, just to observe how the market is behaving, because this has an impact in many other markets, because as you know, all the markets are interrelated. So this is for who I am. And so what I'm going to present to you today is what the Max ETF trading system is. I will illustrate with some trades and make the comparison between the ETF approach and the classical approach we had until last year with the Max. And just a few words about the money management and what we can achieve with an appropriate money management. So, a small history about the Max. The Max has been created many years ago by Dr. Jim Pruitt, known by his students as Tiger, because of a very strong temperament. And believe me, being grown by the Tiger was a tremendous but very educative experience. And Jim was had a strong personality, not because he was a bad man, but because he knew at that moment when he was teaching the Max that his days were counted. And so he wanted to share his experience, his knowledge in trading with as many traders as possible. Indeed, the aim of Jim was to give traders a very powerful but also reliable and complete trading method. And I like to say method instead of system, because the Max is really a methodology, as you will understand progressively with my presentation. So if the Max is based on simple concept, the Max is not so easy to apply, to exploit. There are a lot of details to take into account. And so there are two keys which are essential to become successful with the Max: is work and commitment. You will not master the Max by just reading in 1 hour a few pages of a PDF document, or by watching a video of 30 minutes, for example. No, it's a real complete methodology taking into account several aspects, every aspect of trading. And so it's a lot of effort, and to sustain these necessary effort, you need to have a strong commitment. If your commitment is to only make money, believe me, this is not a motivation big enough to sustain the effort necessary to master the Max. A stronger commitment is important. And so this is why, in fact, as any big project we may have in our life, you have to define why trading is so important of your life. What does trading allow you to achieve in your life? Trading must be just a tool to produce some other result, helping you to make your life better, or the life of people you love, to make that life better. But there are also other keys or skills to develop: discipline, patience, persistence, concentration, confidence, conviction, I like to say also. Discipline and patience, this seems obvious. Indeed, when a methodology is based on concept and rules, so we have to apply these rules with discipline without never deviating from these rules. And a rule always represents a set of conditions to be fulfilled. And so patience consists in waiting until all these conditions are fulfilled. And when they all match, then you have an opportunity, either the opportunity to open a trade or an opportunity to close the trade. Persistence. Persistence is also a very important feature or skills. No method is 100% successful. Whatever the quality or the complexity or the ingenuity of the methodology, you will have losing trades. There are many reasons to have losing trades. And even with a high winning rate, you may still face important losing streaks. For example, even with an 80% winning rate system, you still experiment losing streaks made of 4 to 10 losing trades in a row. And persistence consists in taking the trade when they are valid trade after trade after trade, whatever your winning rate. Soon or later, the average winning rate will emerge and you will get your result. Never try to overguess what a trade will be and decide consequently to skip or to take the trade with more or less risk for that trade. No, just follow your rules. Of course, there is an aspect how to survive losing streaks. Concentration is also very important. I have said that the max is made of a lot of details to take into account, and this is especially the case when we trade with a small time frame, the 5-minute time frame, the 15-minute time frame. We don't have time enough to think or to do something else. We have to stay focused on what we are seeing on the chart. And confidence, we need, of course, to have confidence in the market, in the ability of the market to develop interesting movements, giving the trade opportunities. We need to develop the confidence in the max itself, in its ability to catch large portion of these movements the market gives us day after day after day, and confidence in ourselves, in our ability to apply correctly the rules, the concept and the rules of the max. And so something I consider as also an important aspect of any trading method is how do we define a trading method? And this is something I almost never see in other trading systems. For me, it is obvious that first of all, we have to define the kind of movements we want to catch and to trade. And with the max, we want to catch trends, but we have to define, of course, also what is a trend. We have to define how and when a trend can start. And the beginning of a new trend we can exploit through a trade this is what we will call a setup, in fact an entry setup, and we will have several types of entry setups. We have to define also when a setup is valid for a trade. And with the max we have 3 types of validation. We want the setup to be technically valid. Does the setup fulfill the correct pattern we want the setup to exhibit? We want also a risk aspect. Is the setup associated with an acceptable risk, or do we associate an acceptable risk to the trade? What are counter-indications to skip the corresponding trade? And then the third aspect we have to consider to have a valid trade is the global context. The global context is any elements outside the price itself which may impact the price or the movement of pairs in the market. Typical elements of the global context is or are the news release. We know that some news release under certain circumstances may have a deep impact in the market with big movements. The monetary policies of the central banks and their daily decisions may impact on in the market. The geopolitical element may also impact under some circumstances, under sometimes the behavior of some currencies and so on, some pairs consequently. We have also to define then how to handle the trade once a trade is opened. until its completion in such a way to progressively reduce the risk we have on that trade until we are in a position when the trade becomes a risk-free trade. We have completely cancelled the risk. Then we can think or consider how to optimize the profit we can extract from that trade. And so we have also to define, in order to close the trade, to complete the trade, we have to define how a trend or the movement we are trading. A movement is maybe only a portion of a trend, and we'll call that a directional movement, can exhaust. We can never predict with accuracy when a trend will reverse, but we can see when a trend is exhausting, even if it is temporarily exhausting, perhaps to reverse a few bars later, a few hours later, or perhaps to resume the movement sometimes later. So what is the max, and what is the historical max? The max is in fact an acronym for three concepts. The M stands for momentum. Let me take my red spot here. So the M stands for momentum. We want indeed to be able to catch a trade when we see momentum, and I must add volatility in the price movement. It's only at that moment that we increase the odds to have an interesting movement we can exploit and have profitable trades. The A stands for acceleration. Acceleration means that while the price is unfolding a trend under some specific conditions, we can add to the trade, we can progressively increase our position with a scaling technique in order to accelerate the profit, to increase the profit we can extract from the movement we are trading. And this must be made very, very carefully. And the X of the max stands for exit. At some point along the trade, we will have to make partial exits, and at some point we will have, when we consider the movement is exhausting, or when we have no other choice, we have to close the trade. And so we have to make several types of exit along the trade. And so the max is essentially a trend following method. I will explain in a moment on some chart example. The classical max was not considering counter trend and consolidation zone trading except in the advanced level of the max, because this is due to the type of movement the price is doing relatively to some long-term moving average. The max also include a very strict risk, trade risk management and money management rules in order to control the risk while we are in a trade, and in order to master drawdowns when we are facing losing trades, and in order to grow safely the trading account when everything goes nice, goes correctly. And so the max can in fact be used in any time frames and in any tradable financial market, not only the forex but also the futures market, which contain the currency market, by the way, the commodities market, the indices, of course, the stock market, and if, in particular, if we can trade the stocks, or if we can analyze the stock with the max, any optionable stock can be also consequently be traded with the max, and so the options can also be traded with the max. So if it is important to understand what the max is, it is also important to understand what the max is not. The max is not a scalping method. We are not interested in catching a few pips in the shortest period of time. I don't believe that the risk increase with the time we stay in the market. This is not true. The risk is not understanding what is happening. And for me, scalping the market is the most difficult way to approach the market. And so the max is not a scalping approach. It's not a news trading method. We are not interested to predict what the news release may be and to try to catch these important spikes the price makes sometimes when we have a big surprise in the news release. It's, for me, it's the worst way to exploit movement in the market, because we have always bad executions when we have just the news release. And we may be wrong in the direction of the price movement, by the way. And it is not, you can guess that it is not an elementary buy and sell system with fixed rigid rules not taking into account what is happening in the market. And so I have, as I have said just a moment ago, so a setup or entry setups are defined as opportunities based on technical aspect, risk conditions, global context. I don't need to deepen further. But of course, we have also exit setups, which are also conditions to close or to partially reduce the position. And so the exit setup are defined, in fact, not as a way to predict that the price may reverse, but defined as risk situations present in the position. We can pinpoint when a risk begins to appear, and when that risk becomes large enough to force us to take some action to reduce that risk by reducing the position we are handling. And we have several types of exit setups. We have exit setup based on technical indicators. Why not? I don't agree with some traders explaining that we cannot use indicators because they are lagging. That has nothing to do. They are nice tools to pinpoint when we have risk appearing in the trade we are handling. Pure price action behaviors also. We have exit technique also made on a combination with technical indicator and price action, especially in the structure the movement is developing. We have also timing consideration. At some time in the day, we have to close the trade if a trade is opened. We have a concept we call a movement invalidation. The price may be in a trend, but at some point, the movement the price is developing makes no longer sense for the trade we are handling. At that moment, it's a good time to close the trade. And of course, I should now add with the ETF concept, I should add also the reversal, the ETF trend reversal concept. So, well, so with the classical max, these last years, 3-4 last years, there are some challenges we are facing. And these challenges are produced under these specific circumstances. You have observed that in some pairs, whatever the time frame, we have poor price action or small price movement. When we use a trend following system, in order to be profitable, we need to have trends. So what to do when we have smaller movements? We can miss some movement, and sometimes you can miss ample movement, because don't forget that an entry setup is a set of conditions to be fulfilled. But if a portion of these conditions, for example, are made with the behavior of some tools or some indicators, for example, sometimes the price moves so fast that the indicators in this case are lagging, and they don't give us the opportunity to catch these movements. And of course, we may have, consequently, some lack of reactivity of these indicators. And then I have explained that the classical max was only considering the trend, but not the counter trend. The counter trend was considered in the max advanced. And for me, this has been always some kind of frustration. Not for me, yeah, of course a little for me, but also for our max traders, because we can see a lot of movements and made of partially a counter trend portion of the movement and a trend portion. And it is a frustration if we cannot combine both of them into one unique movement. And sometimes, because we use time bar chart, we can lose a lot of details in the price movement. Even when you take sorry, a 5-minute time frame for the chart, during 5 minutes many things may happen while a bar is printing. And so these details we are losing can be exploited sometimes to increase the profit or to reduce the risk we have on the trade. And this is an example of what I'm just explaining. Let me retake my red spot here. This is the evolution of the momentum and volatility over a year since 2010, so over the last 7 years on some pair, but this is typical of any pair. I have taken here the Euro-US dollar. And we can recognize that after 2008, 9, 10, when we have had an important momentum and volatility, then progressively we are seeing these momentum and volatility decreasing, which can be measured by the average daily range. So this chart, in fact, represents the evolution of the average daily range. And so we can see that for the moment we are at a low level of the average daily range. This was true for the euro US dollar, but it is true also for the pound US dollar and for any pairs you may consider. And so what to do to continue using a trend following system when we have smaller average daily range? This is an example, two examples also on two crosses, the euro NZD, Euro Kiwi, or the pound yen, for example. The phenomenon is the same on every pair. And so in order to overcome these challenges and to adapt to the market conditions, what we have made within the MAX team, we have introduced two concepts, the ETF and the SUM concept. Here I will only describe what the ETF concept is. And we have decided very recently to make the ETF concept available in all our MAX courses, whatever the level of the courses. And what I'm presenting here is especially the ETF concept in the MAX Primer and in the MAX Standard. We have also the MAX Advanced and the MAX SUM, but the ETF now is available in every course level. And so we have introduced that concept in order to trade more movement, many more movement, to catch many more opportunities, to catch whenever it is possible larger movement, which may be composed, for example, with a portion of a counter trend and a portion of a trend, as they were defined in the classical MAX. And so these new movements we can trade using the same concept of the MAX, we call them the directional momentum movement. And so the best way to illustrate what I'm explaining is to show some example. This is the first example of a recent trade made recently, a few days ago. In fact, it was, I think it was Monday, on the pound yen. Let me take here my red spot. And so I make you the comparison between the classical MAX Primer and the ETF, the MAX ETF Primer. And so the white notations represent the MAX Primer, classical MAX Primer trade, and in yellow, the MAX ETF Primer trade. And this is an example of a movement, which was a rather important movement, more than 100 pips. The classical MAX Primer is not able to catch, simply for the following reason. In order to have a technical valid setup, only on the technical aspect, we need to have an appropriate price pattern in the price behavior in relationship with the behavior of our moving averages. We have 4 moving averages. This yellow line, which is called the momentum line or the MO line, a blue and a red balance line, and our home base, which is a long-term moving average. When the price is moving below the home base, we look only for short trades. When the price is moving above the home base, we look only for long trades. But sometimes, even if the price here is moving below the home base, and so we are looking for short trade, the conditions are never fulfilled to catch a trade with the entry setups of the MAX Primer, the classical MAX Primer, despite the fact that it was an important movement. But with the MAX ETF Primer, the way we have redefined what is a tradable movement, so the tradable movement was all that movement here, starting from that point, that red candle with that white down arrow, up to this movement here with that blue candle where you see a small horizontal white line. And so this is the movement, the type of movement we are now able to catch with the MAX ETF. In this case, the MAX ETF Primer. What is the Primer version of the MAX? It's a very simple approach. We open a trade and then we exit in 2 steps from the trade. Let me show exactly this example. So on this point, we have all the conditions being fulfilled to have an entry setup we call an ETF S&P MO. We have, so at the beginning of the down movement, the real reversal has been made here. This is the highest high of that movement, and the reversal happened so there, but it's almost impossible to catch the reversal on the correct bar unless if you can use some other techniques, for example, using price level. So we have also price level, by the way, within the max. So here we have a technical entry setup. The risk aspect and the global context were fulfilled. What we consider whenever we have to open a trade, the trade is made of 2 units. The size of these units are calculated based on the risk we associate, the financial risk we associate with the trade, and the size of the stop loss. You can already observe that the stop loss size is a rather small stop loss. We are in the 5-minute time frame here, okay? And so the trade is made of 2 units, and at some point we have here the condition when the risk becomes important enough to reduce the position, to reduce the size of the trade, in which case we close 1 unit, and we call that action an MX, a momentum exit. We close 1 unit, we bank the result on that unit. It may be a profit, it may be a loss. In this case, it was a profit of 18 pips. And then we keep the remaining open unit until we have the next exit condition. And the next exit condition appears in this case here, at this point, when you have that small white horizontal line, a segment of line, and because we close the second unit, and so we close the trade, we call that an XXX. And that second unit has got a very nice profit of 78 pips. And so we can see that the first trade here has made 96 pips, representing for a stop loss of 18 pips, a reward to risk ratio, a realized reward to risk ratio of 2.67 R. And so this means that using 2% risk per trade, this trade would have produced a little more than 5% profit. And later on, we had the opportunity to open a second trade here with a setup called an ETF RE, which represents a continuation of the trend, again with 2 steps, exit steps, a first MX here and then the final close. And so here that trade has made a small reward to risk ratio. This sometimes happens, plus 0.4 R. And so why have we been able to catch that movement? First of all, we use a more sophisticated approach to define our technical setup with these 2 lines we call ETF lines. They are extremely regular and they reverse faster than any of our other moving averages. And we use also that indicator here at the bottom of the screen of the chart, which is made of 2 parts, a slow bias or long-term bias. It is the line in green and red, and a fast bias in blue and brown. And it's the combination of these 2 lines which help us to pinpoint when a trend, what we call an ETF trend, is reversing. And in fact, when the slow bias essentially is red, we will look for short trade, and when it is green, we will look for long trade. And so, in that way, technically, we could be always in the market. Short, long, short, long. But of course, under some circumstances, trade must be avoided. For example, if the global context tells us that on the pound yen, we have to stay short after this trend reversal, we would not take any long trade in that movement. We will wait for the trend to reverse as it has made later that day. We never know in advance how far the price will go, but we can catch many of these movements. And as long as the price makes a movement of 15 to 20 pips, chances, even with the max ETF, primary chances are very high that we can extract a profit from that movement. Now, the same movement made with the max standard, and especially the max standard ETF. And I like that movement because in this case, even the classical max standard has not been able to catch that movement. The max max standard is the level when we add the scaling process. And with the ETF standard level, now we are able to exploit that movement with the full power of the max with the scaling process. So we start the trade exactly at the same, not exactly at the same point as the max primer. This is an example when the entry, we have been forced to delay the entry by 1 bar. There are technical conditions for that because with the max standard we add other technical tools. The stop loss was at the same place, so it was a little bit larger, 22 pips instead of 18 pips. And then we have our first MX here, then a scale-in. Whenever we make a scale-in, we add 2 units to the position. The size of these 2 units are the same as the initial 2 units. Then we had another MX here, we close 1 unit, then another scale-in, then another scale-in here, so we have already 3 scale-ins. We had the possibility to add another scale-in in this area, but I have a rule which tells that we never, or I never make more than 2 successive scale-ins. In order to make a third scale-in, I need to have an MX. This is one of the ways to control the risk we have on the position. Scale-in after scale-in. Then we have an MX, then we have another scale-in, then an MX, and then at this point when the trend is reversing, we have in fact our X-axis closing. We had at that moment 4 open units, we closed the 4 open units. And by the way, the close of this candle, blue candle, corresponds to the entry setup of that uptrend, ETF trend. And so now that we add the scaling technique to the max, this changes the result of the trade. Instead of making 108 pips with the 2 trades made with the max primer, representing a reward to risk ratio of a little more than 3 hours, now we have here 236 pips. Not a big result, but still an interesting result. And by the way, it's not the pips which are important. What is important is the realized reward to risk ratio, 5.36 R. This means that with a risk of 2%, that movement, which has lasted from 1 hour after the London Open until 1 hour before the US Open, so 3 hours approximately, the reward, the profit with a 2% risk was more than 10%. 10%. Even with a 1% risk, the reward to risk ratio would have been 5.3% increase of the trading account. R represents always the financial risk, 1%, 2%, and so on. And we have lots of movement day after day of that nature. It's extremely rare, whatever the pair you are trading, to not see at least one such movement during the day, essentially during the European session, sometimes during the US session, and less frequently during the Asian session. Well, so this was a first example, a recent example. Another example was on the Euro Kiwi. I will go a little faster here because now you know what we are doing. And so this is an example when we are able to combine a counter trend with a trend movement. Here we have a movement going through our home base, and with the classical max primer we look only for short trades when the price evolves below the home base. And so the entry was here. I'm using the white notation to illustrate the max primer trade. So we had here an entry, and then later here an MX, and then the XXX. So one trade with one entry, 2 exit, and a rather large stop loss. With the classical max, we use a rather large stop loss. But nonetheless, an interesting trade with 70 pips profit representing a 1.35 R for the realized reward to risk ratio. But with the ETF primer, we are able to combine counter trend with trend in such a way to have larger movement, and in this case the trend reversal has happened even in this area. I have not counted this trade here. It would have been a small trade. I've counted only that movement. So we had the entry here way before the price has crossed our home base, then an MX, and then an XXX. I'm now using the yellow notation for the max ETF primer. So a first trade with only 40 pips, a small but interesting profit because we have smaller stop loss, 0.83 hours. And then a second trade starting here with an MX on the same place as the max classical primer, and then the same XXX as the classical max primer, and giving so a second trade of 52 pips with a reward to risk ratio of 1.53, a larger reward to risk ratio because we use a smaller stop loss. And when we combine these two trades, we have, as you can see, a larger reward to risk ratio, not exactly the double, but not too far from the double from the classical max primer, simply because we are able to catch larger movement. Now, the same movement taken with the max standard and the ETF standard, when we are able to add the scaling technique, I will not go to the detail, but with the classical max standard, we look only for the movement here below the home base. We had one trade opportunity. By the way, it was exactly the same as the max primer. We had no opportunity to make scaling. This sometimes happens, so the reward to risk ratio is the same. But with the ETF standard, having the possibility to open the trade earlier, now we have the possibility to add scalings to the trade. With the max ETF, we are able to make many, many more scalings. And in this case, we had 1, 2, 3 scalings, and 1, 2, 3, 4 MX before the final XXX for a result which was way, way larger than with the classical max and 5.06 R instead of 1.35 R. And so you can compare how we can progressively increase the profitability of the trade with upper level of the max. And again, you can see that that movement was corresponding when the price was going downward here in the bias, the long-term bias indicator. So this is what the max ETF with its companion indicator, which is the directional bias indicator in the bottom of the chart, is in fact. The examples I have used are in the 5-minute time frame, but we can of course use the max in any other time frame. This is an example on the pound Aussie with the daily time frame. And so you can observe, I don't need to go into the detail, but we have here with the max primer, the classical max primer, we had no trade. And with the max standard, the classical max standard, we had only one trade, which was here. With a trade we call a BTMO, only one MX and one XXX, no scalings. And so a poor movement with a small result. But we can see that intuitively the entire movement was all that movement here. Okay? And so with the ETF concept, now we have something completely different. Indeed, for the max primer, we had 2 trades, one starting here, with an MX on this point and an XXX here, then another trade starting here with an MX here and an XXX here. And so these 2 trades represent a total of, in the daily time frame, 1,776 pips for a total reward to risk ratio of 2.72 R. We have, of course, similar reward to risk ratio in any time frame. Simply, we may have many pips in the movement, many more pips in the movement, but our stop losses are also larger. But with the ETF concept and its bias indicator, we are able to catch that entire movement. So with scalings, and so we have an entry here, a scale-in, an MX, a scale-in, an MX, a scale-in, a scale-in, an MX, and then a final XXX on this point. And now the result is completely different. On the last exit here on the XXX, we had 2 and 2 and 2, so 2, 4, 6 open units remaining from all the previous scalings. And so instead of having a 7.28 R result with the max standard, we have now with the instead of having with the ETF standard we have, instead of having a 0.29R with the max standard in this trade, we have now a 7.2R result with the ETF standard. So you can see how going progressively from the max primer to the max standard, whether we include or not the ETF, we increase the profit. But with the introduction of the ETF concept, we increase further the result we can extract from the movement while keeping the risk extremely small. Because we have a very strict trade risk management for that. Whenever we have a losing trade, we will have always a small loss. Indeed, this is an example of a losing trade, and this happens whatever the level of the max we are using. For example, at some point we had an entry set up to go short. We are below our home base, so we look for short trade, and immediately after, this is something we have all experienced, the price immediately goes against us, making a pullback. Whenever the price is making a pullback, we never know how deep the pullback will be. If it is a small pullback, but deep enough to force us to close the trade, we will have a loss. But at some point, the pullback will be deep enough to be a trend reversal. So this is an example of a typical losing trade. So immediately after the entry, the price goes against the trade. We are forced to make an MX, so we close one unit because we have all the conditions telling us to make a close. And then later, at this point, we have all the conditions telling us to close the remaining trade before the price has a chance to reach our emergency stop loss. And so this is a typical losing trade. The volatility was too high, in fact, during all that movement, especially for each pullbacks. And so you can see that the loss is, in this case, 22 pips negative, and with a stop loss size of 24 pips, this gives us a reward to risk ratio of minus 0.46R, so just a little less than minus 0.5R, half R. It is not minus 46R, this is a typo, it is minus 0.46R, so just a little less than minus half R. And of course, these are examples of trade we can never avoid. We have tips telling us, or guidelines telling us when we have to skip a trade, mainly when we consider the global context or some timing consideration during the day, but we cannot avoid all of them. And there is also one concept we have with the max. We define what we call price mode. We have the trend mode, we have the consolidation zone mode, for which we have to make the distinction between a tight one and a large one. We have the counter trend mode, we have the spaghetti mode, and we have the choppy mode. This is an example of choppy mode. We explain in details how to recognize these modes. For most of them, the trend mode, the counter trend mode, the consolidation zone mode, we can recognize within 1 or 2 bars when the price leaves or enters into one of these 3 price modes. For the choppy mode and the spaghetti modes, it takes more bars to recognize that we are not in a normal market behavior. The price is in fact ranging either in a tight range or in a rather large range, making even erratic movement. And so when we are in a choppy mode, fortunately, due to the way we define technical setups, it is extremely rare to have valid setups. But from time to time, we may have a valid setup. And in such a case, we teach in details how to be extremely careful in order to handle the corresponding trade. We don't handle a trade in a choppy mode like we handle a trade in a trend mode or in a counter trend mode. So the price modes are very important in order to know how to handle a trade. So this is for the behavior of the max and the different level of the max. And so when we are able to control the risk we have for the trade, then the money management is essentially how we can increase, how we can grow trading capital by the mechanism of compounding and if necessary, when we are facing drawdown and compounding. Just the effect of compounding. You have seen through the example that sometimes we can catch extremely important results with the max. But it is not an obligation to catch important profits. Even small profits, if they are regular, allows to increase nicely an account. For example, here, let's suppose we start with, let me take the red spot here. Let's suppose we start with a $10,000 capital and we use a 2% risk per trade. This means $200 for each trade. And let's suppose, just to make some projections, that we have an average stop loss of 30 pips, which is large for the max ETF. And let's suppose that we are able to catch through within one or several trades 60 pips. This means that our rework to risk ratio is 1 to 1. Don't forget that we use 2 units per trade. And so whenever we add the pips of each unit, we have to average the result in order to have the real result of the trade. And so this is why when I say 60 pips, we have to divide by 2 the number of units per trade. So this gives 30, and 30 divided by the size of the stop loss, 30 is a 1 to 1 rework to risk ratio. So this means that 2% per day. You can use also 1% per day. But here, if you are able, and I don't say it's easy, don't get me wrong, okay, but it is just to give you an idea of what you can achieve with the max. And by the way, you will have access to this spreadsheet in such a way that you can make your own projections or simulations. So let's suppose you are able to make on average 2% profit per day and you trade every day of the year. This represents approximately 250 trading days. And the question is, how many days do we need to double the account to go from 10,000 to 20,000? And so when you have such a spreadsheet, provided the conditions I have mentioned are fulfilled, we can see that in around 36 days, so around 2 months, we double the account, provided we don't make a withdrawal from the account. But this is a strong assumption because some days you will make certainly more than a 1 to 1 rework to risk ratio. Some days you will make less, some days you will make a loss. But this gives you a global idea of what you can do and how your account can grow, especially when we use the special techniques I teach in the Max Advanced course to handle the drawdowns. Because in the Max Advanced course, I teach how we can completely control the drawdown. And if you are a little more comfortable and skillful to use the scaling technique, I have just here considered a little more pips per day. Instead of 60, 100 pips per day, whatever the number of trades you make during the day, 1, 2, 3, 4 trades during the day. And so in such a case, all the other assumptions are true, but this time I consider withdrawing 5% of the account, 5% of the account every month. And so we can see that in this case, after the second month, you withdraw here more than $1,800 from the account. On the third month, you extract more than $3,500, and your account is still growing. And in fact, you double your account after approximately 4 months, but you have already withdrawn more than $6,000 using the withdrawal technique. So the money management is extremely important in association with the trade risk management. The trade risk management is in fact the key to have a good money management too. Well, so now just to complete my presentation, the segment of my presentation here, so the Max courses are organized in 5 levels: the Max ETF Primer, the Max ETF Lite, the Max ETF Standard. The difference between the Primer, Lite, and Standard I will show, Craig will explain in a moment, is simply in the numbers of entry setups and exit techniques and the scaling technique. And the Lite version is a light version of the Standard available for all those who have taken the Max Standard. Afterward, they can come back every time they want to the Max Lite when we give a light course or through videos. And then we have the Advanced and the SAM, which are more and more advanced level in order to exploit more and more opportunities in the market. By the way, For those of you who were present yesterday during the non-farm payroll, I have used the Max ETF primer. Next time, perhaps when we will have our open house session next week, I will illustrate the Max ETF sum in comparison with the ETF primer, just to show you the difference of both and how the ETF sum gives more opportunities and more details in the price movement we can exploit. And so today our presentation, our proposal will be for the ETF primer and the ETF standard course. And so in conclusion, at least for my conclusions, with the Max ETF, whatever the levels you want to study and apply, you have a trading methodology based on sound concept. We explain why these concepts work. For example, we explain why some entry setups and exit setups are important in relationship with the behavior of the big boys in the market. We explain why and how the news release have an impact in the market. We explain why the global context is important. Of course, it's not possible to be exhaustive in terms of the global context, but we try to be as clear as possible on that aspect. And the training we give put the focus with an important, with a lot of importance in several aspects. So even if we use indicators, we don't trade indicators. The indicators are just a tool to go faster, pinpointing some interesting aspect in a movement when we may have an opportunity to open a trade, when we have a risk for the trade. But we trade the price action. Always the price action gives us the final decision we have to take and to apply. We have with the Max a solid trade risk management and money management. This is important to survive any drawdown we may face and to grow the account. And so, as you have understood, we attach a lot of importance to the trade risk management. The first priority of a Max trader when a trade is open is only to concentrate on the risk reduction or cancellation. And so we attach a lot of importance also on the personal confidence through our coaching or mentorship approach, the homework we require to our students, the practice we have regularly, the follow-up support we provide in the workshops we have, in the forum we have, in our practice sessions we have every Saturday. We call the scrolling parties for our Max graduates. And so this helps to refine some nuances and to go deeper and deeper into the understanding of the Max for our students. So this is what the Max is. So, and if you have any questions, feel free to put them in the question area. And now I give back the mic to Craig.
Thank you, Sabio. I want to take a moment and introduce Chris, even though he was not able to be with us today. An important part of our Max team, living in New Zealand, and a nice guy and very, very helpful around the Max community. He can help with almost anything, including instructing in our courses. So you'll have an opportunity to meet him at another time, and you can look forward to that. Next slide, Eusebio. Are you still there, Eusebio?
Yes, indeed, and I have changed the page.
Oh, you did it. There we go.
Yeah.
This is just a little slow on my screen. Sorry.
Sorry for that.
One of the unique aspects of Max course training, and I'm really not aware of it somewhere else. If you are, point that out to us. I'd like to see it. But we do ask you to do homework as a part of your training. It is a very, very good way for you to know as a student of the system how you are progressing in learning it. Are you really understanding things? Are you able to put what you've learned into practice? And as our instructors look at your homework, they will provide you with tips, comments, suggestions. And when you mix all that together, it just solidifies your learning, moves you along in your progress of learning the system, and you'll find it to be a very, very crucial and critical part of your training. Every session includes a homework assignment, and of course we have no way to force you to do the homework, but we highly recommend it, and you will quickly learn how much you benefit from it. You can pause the video and take a closer look at the slide when you get the video. Eusebio, please. Personalized feedback on your homework, and again, you can read more about it and take a look at this example just by pausing the video when we send it out a little later. Next slide, please. And this screen gives you a close look at the various courses, and someone has asked, why do we teach different systems? Why do we provide training in different systems? And the answer is, really, we don't. All of this is one system, the Max Trading System, but there are various levels of the system. The ETF Primer is a subset of the ETF Standard course, and it's obviously is not as profitable, but it is a complete system. You can take the training in a 2-week period versus 7 weeks for ETF Standard, but we strongly recommend that you begin with the ETF Standard. If you have at least 4 or 5 months of experience in trading, it is perfectly fine and recommended that you begin with the more profitable level of the Max system, the ETF Standard. It's our flagship training. It's our original training as developed by Dr. Pruitt and enhanced over the years, and it is an excellent place to get started. But for those who cannot afford the ETF Standard and still would like to have a reliable trading method, then the ETF Primer is there for you. And again, I recommend that you pause the video here and take a close look at this chart so that you have a better idea of how the different course levels might affect you and your training. Okay, next slide, Eusebio. And by the way, don't forget that all of the Max courses are available by video. You do not have to attend the live webinar class sessions. This makes it very much more convenient for those who live in time zones that are not very convenient when compared to the time of our training sessions. Also for those who just need to start and progress at their own pace. So for a variety of reasons, about 40 or 45% of our students study entirely by video, never attending a live webinar. But for those who prefer to attend the live webinars, you also get the video so that you can do more thorough study of what has been presented in the class session. The courses are detailed, they are precise. You will need to concentrate and do good work and good study throughout the sessions. We use the MetaTrader platform, MT4 to be exact, simply because it's freely available to all students. You have a complimentary data feed, so there are no extra expenses with the training, and we provide everything that you'll need. The templates, indicators, and so forth all come to you along with some helpful notes, a PDF of the screens that are used throughout the class session, and anything else that you might need. We do our best to provide for you. Next slide, Eusebio. Again, we emphasize the homework, and after the course has been completed, we have some bonuses for you. The Max Trading Forum, a private forum, will be made available to you at the level you have completed. For example, if you have completed the ETF Primer course, then you will be admitted to that level of the forum, and so forth as you progress throughout the courses. There are lots of things that will be very helpful to you in the forum, hours and hours of video there for you. You can ask questions, you can present charts for comments, indicators are stored there where you can download them. So it's a very helpful tool that you'll want to use. We also provide the News Watch list, and we'll be giving you a link for that so that you can take advantage of comments on the news and recommendations on pairs to trade. And then we have our weekend workshops, practice sessions that we affectionately call our scrolling parties. These are 2-hour workshops presented not quite every weekend, but most weekends. And so regardless of what level of max training you have attained, there will be at least one workshop for you every month, and there's never any cost associated with that. So you get a very solid trading method. You get all the support that you could ask for, and all you have to do is ask, and there's no limit to it, and there's no time limit to it. And although trading is not easy, you have at your fingertips one of the best, most effective, most powerful trading methods available. And it certainly is a wonderful tool to help you achieve your goals. Eusebio? The Max ETF Standard course is our flagship course, now upgraded with the ETF indicator. You get that indicator, no extra cost for that. You get the training to use that indicator with our standard methods, no extra expense associated with that. And so you also get the max profit acceleration techniques, the scale-ins, the money management, a full and complete system, very good at protecting your account, wonderful risk management. The course begins on the 8th and runs for 7 weeks, meeting weekly on Thursday. The starting time is 4 o'clock p.m. New York time, Eastern time. And you don't have to attend, but you're very welcome to attend. And if the time is not good for you, then you can study entirely by video. So beginning February the 8th, running for 7 weeks. And we do have a very special opportunity for you on the tuition rate. $23.99 is the price for you simply because of your taking time to attend this webinar, or perhaps you have been in one of our trading sessions. Because of that, we offer these just for you. And we also have a 3-course package deal, $26.79 for 3 levels of max training. You would begin with the ETF primer course, move on to the ETF light course, and then right on into the full ETF standard course. Why would you want to do that? There's a couple of possible reasons. You may be one who simply learns better with more repetition. You may be one who likes more exposure, and as you progress through the courses, you see things more than one time, and the increased exposure gives you a better opportunity to learn and apply what is being taught. And by the time you have completed all 3 courses, and it will be about 2 weeks for the primer and about 3 weeks for the light, and as you know, the standard course runs 7 weeks. That's a lot of exposure to the max system, and you'll be well on your way to becoming an accomplished user of the max trading methods. So many traders like to take advantage of this 3-course deal. It saves you a lot of tuition funds on that. Eusebio, the next slide. The ETF Primer is our 2-session course. It meets this time on the 12th of February and again on the 26th of February. Those are not repeated sessions. They are 2 completely different sessions. Over the the course of time in this training, you will get, we've said 6+ here, but it's really more like 8 hours of live training. And you will get, along with that, all the templates, of course, the indicators, everything that's needed to use the system. You'll learn our safest entry, and you'll learn some good exits out of that trade. So it's a wonderful way to get started. If you have trouble coming up with the funds for the ETF standard course, or maybe you're just someone who likes a chance to sort of kick the tires, give it a try before investing in the full training, then that's your opportunity on February 12th through the 26th. We have a very special tuition rate on that for you, $159 rather than the website price of $329. And we have a 2-course package also available. It's the primer course plus moving on to the light course. So both courses for $759. That saves you about $300. So some of you will want to take advantage of that. Eusebio? And so this slide simply gives you an overview of all of the discounts that are available to you. I will be repeating that via an email to you and sharing the links with you. You don't have to take time to copy the links off of these slides. I'll drop them into the chat for you in just a few moments and then send them to you by email as well. So this is coming up right away. I want to remind you, on the 8th of February, that's Thursday. So it's coming up right away. So don't take too long with this. Jump right in on it and get enrolled. And we have some pre-session materials for you to study, some preparatory studies that will be very helpful to you to have those and have that done before you begin with the first session. And then the ETF primer coming up on the 12th of February. Not that far away either. So give some consideration to what is best for you. If you have questions, please ask. We want to help you know what would be the best level of max for you to jump in on. All right. Thank you very much. I think we are ready, Eusebio, to consider any questions that traders may want to ask. So if you have something, please drop it into the question area of GoToWebinar for us.
Yeah, and Craig, while the attendees are posting their question, let me show here the news watch list Craig was mentioning, in fact. So every week, during the weekend, the Saturday usually, we update what we call our news watch list. You can access here. Craig will give you the link. So but it's www.maxtradingsystem.com/newswatch. And every week, so we prepare the list day after day for the week of the news which are really important. Not all the news move the market. And so we pinpoint the news which are really important with 2 types of description: major news and monitor news. A major news may have an impact in the market. A monitor can simply create some additional volatility, but not being as crucial as a major news. We don't trade when we have the release of these major news. And so we give a lot of information about these news. For example, if the news may have also an impact in higher time frames, what is the bias for the currency, the corresponding currency we can expect until the news release, and when the news is released, the bias may change. And so day after day, and after that we provide also a list of pairs which are the best moving pairs and for the recent past, and which has a great chance to still be nice mover for the coming week. And so we call it the top 10 pairs. Usually it contains between 10 and 14 pairs, maximum 14 pairs. And then below that, we have a suggestion day after day for the coming week, of a small list of pairs to consider based on the news release. And for example, for Friday, the suggested pair to monitor and to trade eventually based on the news release only was the pound US dollar, the pound New Zealand dollar, the pound yen, and the euro US dollar. And we don't catch, of course, the best moving pairs every day, but many of them have nice movement, which gives nice trades day after day after day after day. And so this is something I wanted to show you. And now, if we have some time, Craig, I would like to make the same experience we have made some times ago, illustrating on the MetaTrader platform what the max may be. Do we have some time before you give the winner of the Max Primer course?
Yes, that's good, Eusebio. Let's do that.
Okay, let's do on the platform. So, and what I would like to ask to one of you is to give me any pairs made of the 8 currencies. Give me first of all any pair, and we will stay in the 5-minute time frame to make it simple. Oh no, we can choose also the time. So give me any pair. The first one giving me the pair will be the winner here. So give me a pair, any pair. Okay, the euro US dollar. Okay, we have the euro US dollar. Give me a time frame now. Give me a time frame. 15 minutes. Okay, the 15-minute time frame is the first time frame which has been suggested. So I will take the 15-minute time. I have to change a setting here just to be in agreement with the 15-minute time frame. So just give me one moment. This way. And now give me a date, any date within the last 3 months. Any date within the last 3 months. I say 3 months because we need to have the corresponding history in the... Okay, the first date is the 15th of January. Oh, Omer, you are fast in typing. So let's go on the 15th of January. So 2018, January 15. Okay, which is so this day here on the 15-minute time frame. Now, when we consider a pair like the euro US dollar, the best session to trade that pair is the European session. So let me pinpoint here when we have at least the Frankfurt Open, which starts here. Okay, and I will draw that in yellow as I am used to do that way. This is the Frankfurt Open, and sometimes we can even consider half an hour before the Frankfurt Open because we have some other market opening. So starting with the Frankfurt Open, we will look for either short trade or long trade depending on how our directional indicator bias, the directional bias will tell us. And so first of all, we have here a downtrend. And so after the Frankfurt Open, we look for a short trade. When we observe this portion of the chart, we don't have a valid entry setup to go short. And so suddenly here on this bar here, let me use a green line now, dashed line. Starting in this area, we look for a long trade now, okay? And we have, in fact, an entry with this candle here, and we can catch this portion of the movement, and we can handle that movement, which is the total movement of around 47 pips. We can catch a large portion of that movement, and after that, we look for a short trade. But unfortunately, the price made nothing, and we had no entry price level to go short here except at this point, and this would have given a small losing trade. So it has not been a very easy day that day with almost no movement, but one winning trade and one small losing trade. And by the way, we have also to exclude the trade when I see such a candle, if this candle with a long wick corresponds to a news release, this trade would not have been taken. Okay, so the directional bias indicator tells us in which direction we have to trade. I will take another example quickly, and I will take the second pair which has been proposed, which was the pound US dollar. So let me go on my chart here, the pound US dollar, with the 5-minute time frame. I'm already on the 5-minute time frame, and the second day was 18th of January. So 18th of January. So this is the pound, and so let's draw the Frankfurt Open. The Frankfurt Open was right on this candle, and so here we can look for a short trade which happened in this area, in fact. Okay, and we would have been able to catch that small movement with a profit or with a break-even. It depends how we make our thing, but the direction of the trend was, or the movement was correct. Then we have, from this candle, we have to look for a long trade. Of course, I'm ignoring for the moment the news. Okay, so let me draw, in fact, a rectangle on the movement we catch with our directional bias. So we look for a long setup, and the long setup happens here on this candle. And on this candle, we open the trade somewhere in this area, and this would have been a losing trade, okay? But a small loss, because when we have a losing trade, we always have a small loss. And then we have to look for a short trade. We never have a short trade here. And then we have to look for a long trade which happens to appear in that area with this candle here. With this candle here, and so we have our trade. We would have made an MX closing 1 unit with a loss, but then the price moved all along that way until the point here when we had the trend reversal. The trend reversal can be preempt a little early, and the trend reversal, the setup to go short was on this candle, and so we got that nice up movement, which was a movement from the entry to the top, a movement of around 50 pips. And then you see what I mean. After that, we look for a short trade, which happened on this candle. So here, the entry was here. And then until this point here, when we have a trend reversal. So this doesn't mean we close the trade at this point. We have perhaps closed the trade around the reversal, the real reversal here. And so we have been able to catch another winning trade, a short trade in this area. At which point we look for a long setup. We have no long setup happening here. Then a short trade, in this case, this would have been a small losing trade in this area. And then to complete the day, but at that moment we are at the close of the European market, it becomes worthless to trade. But nonetheless, before the London close, which happened in this area, we were still able to catch this movement until the trend reversal which happened. In fact, we can preempt the trend reversal, so here, and so we were able to catch another winning trade here. And so you can see that we have sometimes losing trade. We had here 1, 2, 3, 4, 5, 6 trade, one losing trade here. So 4 winning trade with nice, sometimes nice movement. Okay, like this one, up movement, down movement, up movement, and 2 losing trades. So 1, 2, 3, 4 winning trade, 2 losing trade. So a reward to risk ratio of 67%. But when we have a losing trade, the loss is approximately minus 0.5 R, and when we have a winning trade, the reward to risk ratio usually would be larger than 1 R. And so the expectancy of the max, especially if we are able to use the scaling technique becomes extremely positive. And this is with the max ETF. With the max sum ETF, we go even deeper into the details of the movement. For those of you who will be present to our open session next week, I will illustrate the max ETF sum, and so you will see that this will provide us with many more opportunities and profitability. So we have chosen here 2 dates and 2 pairs at random, and I have illustrated to you how we can pinpoint, and this is true in any pairs in any time frame, how we can pinpoint rather easily nice movement. And when we have an ample movement, and you can make the following test. Take any pairs on the 5-minute or the 15-minute time frame and scroll that pair for 1 year, day after day after day, and you will see that on average every week you will have on average 2 or 3 nice movement made of more than 50 or 60 pips, more than 50 to 60 pips. Okay? This means 80, 90, 100, 200 pips. When you catch a movement of 100 pips or more, you explode your reward to risk ratio. Okay? But you need the courage to stay in the movement and to make the scale-ins when they appear. Okay, this I hope will have enlightened a little more what the max is, and you have appreciated that example. And now, so of course, we can answer any questions you may have before we wrap up this session. So, and Craig will have to give the winner of the drawing. So, any questions? I'm going to scroll through the question area, and I see that Chris and Craig have already answered some of the questions. So, a usual question which is asked is, why are you taking short against your cyan line trend lines? This is a good question, Michael, and this is what I was explaining during this session. In the classical max, indeed, we were looking only for long trade when the price is above our home base. We call that long-term moving average the home base, and short trade when the price is below the home base in this case. But what do we do when we have such kind of movement? If we restrict the trade on one side of our long-term moving average, look what we are losing. We are losing all that portion. And believe me, when you apply the scaling technique, okay, in such a movement, let's suppose the classical max would have suggested, for example, to open a trade here. I don't say this is true, okay? If with the max ETF, we are able to open the trade, one trade even 10 or 20 pips earlier, for example, in this area, it is not a good place. In this area, for example, here, even if it is only 10 or 20 pips before a classical entry, these 10 or 20 pips will have a deep impact in your trading result, because you do not catch 10 or 20 more pips, but these 2 units you open in this, you can consider you hold them until the end of the trade. And so this will add, in fact, the entire movement to your results. You can make a lot of examples to see that what I'm explaining is true. And so the idea is to catch larger movement. The true trend in reality is all that movement. The price was in a down movement and then has reversed to an up movement. The movement is that entire movement. Why not try to catch the entire movement? Of course, we know that when the price will face our home base, because the home base is an important line for even for the big boys, we have to pay attention. It happens many times that the price bounces off when it is in a trend on that home base, but sometimes the price breaks that home base, okay, and unfold a larger movement. And so this is what we want to catch with the new concept we have introduced into the max as the directional momentum movement, or momentum directional movement, okay? So okay, I see the ETF is more dynamic. Okay, it's indeed more dynamic and more logical, in fact, because indeed, who are reversing the market? The big boys. The big boys in all that area, perhaps, and perhaps even earlier, are accumulating long trades. And at some point when the sellers no longer appears in the market, the price has only one direction to move upward. And so this is, in fact, the reversing in the price movement the big boss creates in the market, perhaps starting their position way earlier. The big boys never reverse a market on one candle. This is not true. They accumulate, and this is sometimes when you see such a consolidation area like this one, such a consolidation, if we don't have the volume, like in the Forex, this consolidation may be simply a low-level activity, but it may be also a high level of activity when the big boys accumulate positions in both directions until an imbalance appear in one direction or in the other direction, in which we will have the corresponding breakout. Okay? Well, so for the advanced course, do we really need the home base? The advanced course is something else. Each level of the max build on the previous one. What do we teach in the advanced course? In the advanced course, we teach a little more entry techniques and exit technique, but we go deeper into the money management approach. I go deeper into the trade risk management. I go deeper into some nuances in the price action, and I define in great detail an important concept I call the discretionary situations, when we are allowed to somewhat deviate from the strict rules, but always under a solid argument with the trade risk management. And then we have a more global picture, a more global view of the market by considering the relationship between several markets, or even between several pairs in the Forex. For example, many traders try to consider the correlation between pairs. I don't believe really in correlation between pairs, but I believe in correlation between currencies. And so this is one of the things I teach in the Max Advanced course. Another thing I deepen in the Max Advanced course is the impact of the news on the news release on the price movement. And then another point which is taught in the Max Advanced course is a special technique to have a complete control of the drawdown. What I mean is you can predefine. This means you can define in advance the maximum drawdown you do not want to exceed, for example, 15% of your trading account. And with the money management I teach, and it is not using a martingale, okay, because martingale is the worst approach in trading, especially in Forex. Martingales can somewhat work in the stock market, but never in the Forex market. So I teach a technique to have a complete control of the drawdown in such a way that the drawdown will never exceed the predefined maximum drawdown you have defined, for example, 15%. And so you will be amazed by the technique. We call that Chris has given to that technique the nanny account, nanny, but N-A-N-I, who take care of children, so young children, but this technique takes care of the account, and we can do that because of the type of results we have with the Max. So these are the more specialized, more sophisticated aspects in trading we teach in the Max Advanced. And so everything you will learn from the Max Standard will of course be used in the Max Advanced. And why do we keep on our chart our three classical moving average and the home base? In fact, with the Max ETF, we define new entry setups, but of course, in order to pinpoint exactly when the price reverses, we need to be in front of the screen, which is not necessarily obvious. If we have missed for any reason the trend reversal, we can still use the classical Max entry setup to jump into the trend. Okay? And especially in the Max Advanced, in the classical Max Advanced, I teach how to also trade counter trend, but not as efficiently as with the Max ETF. Okay? So would the ETF primary give enough trade if I trade daily chart? Dailies fit my time schedule better, or you need to trade small time frame to get best result? Michael, when you consider trading, you can never say that one approach is the best approach. The best never exists in Forex. The best time frame today may be the worst time frame tomorrow, and vice versa. The best pair today may be the worst pair tomorrow, and vice versa. As you said, and you are, for me, that's my personal opinion, you are perfectly right when you choose a time frame which fits your situation. And indeed, to trade comfortably, each trader must choose the most comfortable time frame, the time frame matching all the constraints of the trader. It's not obvious that a trader can become a full-time trader. I completely understand that a trader may have another normal job. And so the 5 minute, the 15 minute, the 30 minute time frame is not appropriate for such a trader. The 4 hour, the 8 hour, the 12 hour, the daily time frame is perhaps more appropriate. Even when we trade full time, for example, myself, I like to have trade in the 5 minute time frame, but also in the daily time, because it's a much more comfortable situation. And so, of course, the frequency of the trades, which is an important question for the evolution of the trading account, is an important question. With small time frames, we have many more opportunities. In the higher time frame, you will have less opportunity. But this is true with every level of the max. And so with the max primer, you will have 1 or 2 opportunities per pair, per week, or per month. It depends on the price movement. It's clear that if on the daily time frame the price moves days and days and days in such a way, for example, you will get no opportunity. Let me show, for example, on a pair daily time frame, just to give you an idea. Let's take, for example, the pound yen. And I will take the daily time frame, okay? And I will have to change here one setting, just to be online with the daily time frame, okay? You see here, if I use the daily time frame during these last days, we have a long trade, so here, with the max primer, okay? Then we have a short trade here. During all that time, you will have a short trade here, you will have a short trade here, and then you will have a small long trade here, up to that point, approximately, and then no short trade here, there was no entry setup, and then a long trade here. And so you can see that on a period of 2 weeks, approximately, we had 1, 2, 3, 4, 5 movements, giving 5 or more trades. And this is what you will get with the primer, okay? And it was a time frame when the price was not extremely trending, but you will have period, look here, when the price is making nice downs, up movement, you can catch nicely with the directional bias indicator, okay?
Eusebio, we might also add that traders who feel they have to trade the daily charts, they might also consider perhaps an 8-hour or a 12-hour chart.
Yes, indeed. Indeed, you know that with MetaTrader you can build offline chart, and with the offline chart you can build other time frames. And so especially the 8-hour, the 12-hour, which are extremely comfortable. We have lots of maxers or max traders who use either the 8 or the 12-hour time frame. And for a trader who has a normal daily job, even the 12-hour or the 8-hour may be appropriate, okay? Yeah, and as Robert says, the 4-hour are also good to trade the max. But a bit of caution here. The 4-hour chart will force you to check more regularly your chart. Okay. Now, if you have a normal job, if you have the possibility to check your chart on your job, that's okay. But if you have a boss, you need to have the agreement of your boss. Okay. So this may be a delicate question.
Eusebio, here's a somewhat similar question. He says, I have very little free time and my job just does not allow me to sit at my desk very long. Can I set up trades in advance with this system?
Not really, not really. There are some types of setup which may be defined in advance. For example, we have a typical example here. In this kind of situation, when the price is making a range, that we have to define where is a resistance level. And in such a case, sometimes you can define to make an entry at the breakout of that concession zone area. It's not so easy, but this is not the aim of the max, because you need to take into account several conditions, the technical conditions, but you have also to take into account the news release. And if you preset your trade, this is somewhat ignoring what may happen, especially if you cannot observe your chart. Even in a daily time frame, some news may have an impact. There are 5 or 6 news we have to pay attention. And then you have all the exit techniques. And for that, you have really to observe what the chart is doing. With the max, we do not believe in the concept of targeting a specified, predefined reward to risk ratio, a 2 to 1, 3 to 1, 4 to 1, 5 to 1. No, we take what the market gives us. And for that, we need to track the price. We need to follow the market. Okay? However, what we have with the max is, you can see that on the chart we have small arrows. And these small arrows tell us when we have these two ETF lines crossing. And we have an indicator, okay, which generates an alert, a sound alert, a pop-up window opening on the chart, but also an email can be sent to your PC or to your portable phone, to your smartphone, for example, and you can receive an alert when such the two ETF lines crossing is happening. Because when we have such a cross, this does not mean that we have an entry setup, but we are perhaps approaching an entry setup. And then you can then analyze your chart and define in advance perhaps where the price entry may be. If you are able at that moment to define where the price entry will be, then you can preset an order, you can set a pending order, for example. But for the exit technique, it's a little more difficult. What you can do is create alerts when the price reaches some levels of price, just to force you to check what the chart is doing. I see that interesting, my broker also has MetaTrader 5, which has those time frames. Does the max work on MetaTrader 5? For the moment, no. Any standard indicator, like the moving averages, for example, our home base, our 3 moving averages, are standard indicators. They work on MetaTrader 5. But our Bollinger Bands, our ETF lines, the store RSI, perhaps the store RSI can be found. It is a free indicator, so perhaps it has been converted to MetaTrader 5. But our bias directional indicator and some other indicator we use on the max, for the moment, do not work with MetaTrader 5. We have developed, through the help of some max graduates, these indicators for NinjaTrader, for TradeStation, for most of them, not all of them. For example, the directional bias indicator is not available on every platform, but NinjaTrader, TradeStation, and 2 or 3 other platforms. I don't remember exactly which platform, but in our forums, in the appropriate area of the forum, we explain in which platform our indicators are available. But progressively, we will have to migrate to MetaTrader 5, because we may expect that at some moment the broker will no longer accept we trade with MetaTrader 4. Okay? I think we have answered all the questions, so.
I think so, Eusebio.
A last question. I had trouble with crashes on offline charts. What kind of trouble? Yeah, the problem with offline charts, Michael, is the following. When you want to trade on an offline chart because you want to represent another type of chart, another time frame, or another type of price representation, the offline chart must not contain too many bars. When we have to consider that around 600, between 600 and 1000 bars is enough. Why? Because whenever a new price, a new quotes comes from the data feed, the entire chart is rebuilt, the entire offline chart is rebuilt. And this may slow down considerably your PC if you have long history, many bars on your offline chart, and if you have many offline charts. So keep your chart as small as possible, and you will avoid many problems. Okay? So thank you for details on email sound alerts on ETF crosses. I will try them out. Okay, Robert, no problem. Okay, great. I think we are done with the questions. So,
oh, one other question, Eusebio. Let's take time to do that before we leave. This says, I had trouble trading recently on the pound dollar. After I entered, it kept going against me, up and up and up. I thought it would reverse at 3 different resistance levels, but it didn't. This seems against any logic. Will the MAX system help me with this sort of trading?
yeah, indeed, and this gives me the opportunity to explain something else. One of the how to say that remark which is made on indicators is that they are lagging, and so they can never be reliable, and it's better to use leading indicators. Typical leading indicators are support and resistance, or perhaps supply and demand level. These are lines you draw on your chart. And the argument is, because the price has already behaved in some way on a specific level, odds are high it will behave the same way when it will come back to that level. But if you think about that, a line on a chart is also a technical indicator, and there is no reason for the price technically to respect a level, either a resistance or a support, a supply or a demand level. This depends precisely on the context. It is the understanding on the context of the context that will give you confidence to the level you are considering for the price to bounce off from or to cross. And so with the MAX and with especially our bias indicator, indeed, this will give you a better idea when the price will reach some level, if the price has a chance to either cross the level or to bounce off from the level. Typically, when the price is in a specific trend, chances are high that the price will cross the level. If the price is in such a way that the bias is in the process of reversing, then you can count on the fact that the price will bounce off from that level. Okay, we have price levels in the MAX. We produce them every week. This today, normally I produce them the Saturday, but I will be the Sunday, but I will be absent Sunday and Monday, so I have already prepared them and sent them to our subscriber. Let me show you, for example, on the euro US dollar, what I have made. So I need to open another chart, and then I will draw the levels here. Euro US dollar, where is it? I'm limited in let me do that. Open data folder. Let me eliminate some of the templates. It will just take me a few moments. So delete. I don't know why MetaTrader limits the number of templates available from the list of templates. This makes no sense. So euro, US dollar. Okay, and then I will copy them on my normal chart. And so here we have the euro, US dollar. See here, the price, this was one of the level coming from a previous moment, perhaps several weeks ago. And the price here was reaching the level in all that area. But the price was also in a downtrend. You see the price has crossed the level. Of course, after that, the trend has reversed. But here, the price has not really played a role of support. It has in somewhat played a role of support because the price has failed to go lower. The price has stayed stuck to the line. But because of the momentum to the downside, the price has crossed the level. And later on, when we came back again in a downtrend, the price has crossed the level. The price went to the level, and then here, when we were in the process of reversing the trend, the line, the level has served as a resistance, and the price has bounced off from that level. So when you use a support and resistance level, you must be extremely careful. You see, for example, here, we had that support level. The price has bounced off from that level, but we were in the process of a trend reversing. Similarly, here, we were in the process of a trend reversing. Look, in this area, we were in the process of a trend reversing. This situation was a situation when we could have preempted the trend reversal before the slow bias turned to red. And look where the price was approaching that level, which has been used as a resistance area. And in this area, the price went into a trend mode, uptrend mode, and the price has crossed the level. Okay, and when the price was in the process of reversing the trend, look here, again the level has been used as a resistance to the upside and so a support to the downside. Okay, so these levels must be used carefully, and so if you have a good idea when the trend is reversing, you can make a better use of these levels, especially when the price is in the process of reversing a directional movement. Okay, these levels work really, really well with the max, and so I prepare them every Sunday for the coming week. I update them every week, and so we have two formula of subscription. One free subscription, you get the levels for 4 pairs, the Euro US dollar, the Euro OZ, the OZ yen, and the pound yen, and then a package which is available through a monthly subscription. The price is really cheap, but you have between 15 and 20 pairs. It depends on the moment. We have the indices, the S&P 500, the Nasdaq, the Dow Jones. I have included also the oil, gold, the DAX also, and then at the demand of many, the Bitcoin. And so this gives approximately between 25 and 30 instruments every week. But this is a paid subscription, so, okay? Okay, I hope I have answered that question. So indeed, support and resistance level must be used carefully, and you will increase your odds to have good entries or good exit if you combine them with a trend reversal. Okay, Craig, any other questions? I don't think I see other questions in the question area.
I think that's about it, Eusebio. We've gone a little bit over time, and I really appreciate everyone hanging in there with us and staying to the end. Let me do this for you. I'm going to put my email into the chat here, and if you would email me within the next hour I will send you a link to get a 10% additional discount on the course that you would prefer. When you write, be sure and tell me which course you want, and I'll send you a link to get a 10% bonus discount, just to say thank you for staying with us through this long webinar. Eusebio, I'll leave the last word to you.
Okay, so I would like to thank you very much for your patience in attending these presentations. If you have any other question, you can always send an email. You see an address email here. Craig will also put another email address in the question area. So with the Max, you have a very nice trading methodology. It's not easy to apply. It requires a lot of effort, as any serious trading system. Believe me, I have seen bank traders trading in the market. They use more or less sophisticated approach, but most of the job is prepared for them by specialized department. But you are not in a banking environment. You have to do all the job yourself. Believe me, it's not so easy. And with the Max, we try to help as much as we can with trading methodology, with our forum, with our news watch list, and the suggestion of pairs every day, and the max price levels and future development we will have in the future. And so I hope to see you in one of these two courses, the Max Premier or the Max Standard. The Max Standard is really a complete methodology. You will have a lot of profit from it, and so I really hope we will see you in that course starting next week. In that context, so I wish you a great rest of the weekend and a lot of success in your trading activities. That being said, so bye everyone and take care.